Hello, everyone. Welcome to, I think this is our 9th monthly national outreach call at Real Progressives and Real Progress in Action. I'm Virginia Cox. I know a lot of you. I've been here for about 2 years. I'm the co-editor-in-chief. I work with writers, and I'm also on the podcast team. If you haven't heard our amazing Macro and Cheese weekly podcast, then what are you waiting for? Robert Hockett, our guest tonight, has already been on, I think, 2 times. He's always exciting and fascinating. The reason we wanted Bob to speak tonight is not just because he's such a likable guy, although that's part of it, but he's always doing really interesting things, and he's very good at explaining it, even to people who aren't academics or economists. And one question I always want answered is, why am I supposed to know this? Why is it important? So I hope he'll be answering that. I want you guys to know there's going to be a Q&A. If you have questions, please let us know in the chat window, and we'll either call on you, or if you'd rather just type your question in, we'll ask it for you. And then Steve's going to come back and talk a little bit about Real Progressives in Action. He started doing it now, and he'll tell you how to get involved. So Steve, would you please introduce our guest?
We are so pleased to welcome Robert Hockett tonight. Bob has been a good friend to Real Progressives and myself over the years. His list of accomplishments is so long it would take a whole hour to get through them. Robert Hockett is the Edward Cornell Professor of Law at Cornell Law School, visiting Professor of Finance at Georgetown University's McDonough School of Business, and Senior Counsel at Westwood Capital, LLC. He specializes in the law, economics, and philosophy of money, finance, and enterprise organization in their theoretical and practical, their positive and normative, and their local, national, and transnational dimensions. You can find his work in Forbes, Business Insider, Wall Street Journal, The Hill, and NPR, and other places such as Macro and Cheese. So Google him up. It'll keep you busy for days. And with that, Bob, thank you very much for joining us. And I look forward to listening to Community QE.
Thank you so much, Steve and Virginia. It's great to be on with you again. When Steve and Virginia approached me and asked me to sort of join this evening, they asked if I would talk, among other things, about Community QE, as I've been calling it. This is essentially a sort of happy name that I've given to a new Fed facility, actually about a 2.5-month-old, maybe 3-month-old Fed facility almost now. And it's a sort of optimistic naming of it, chosen on the basis of what that facility could become or could be made into being, but isn't quite yet. So with that disclaimer, I'll say a bit about what I'm referring to when I talk about Community QE and why it's at least potentially important, but what we still have to do if it's going to sort of live up to that potential. So here's a way of thinking about all of this. We have a national pandemic underway. It is national in scope, and in many ways accordingly requires that we address it with something like a national agency, right? Some sort of national form of collective action. We have various federal agencies that normally are meant to do that kind of thing. Indeed, that's why we have a national executive. That's to say, it's why we have a president of the United States rather than just having the Congress and then a bunch of state governors. So ordinarily, things like pandemic response, which are akin to war, I suppose you could say, in the sense that they require collective action and thus require mechanisms of collective agency to address and to deal with, we normally deal with in that way. And federal agencies are also federally funded. And as all of you who are regulars with Mac and Cheese know, to say that something is federally funded is quite significant. It makes it rather different in kind, not just in degree, from anything that's funded by a state government or by a local government or by any sort of private sector entity. The reason being, of course, that at least in a nation or a sovereign jurisdiction that issues its own currency, there's no sort of financial constraint or financial limit on what kind of funding can be done. You've only got to worry about natural constraints. That's, of course, a commonplace for all of you who are regulars here. The problem that we have at the moment is we have a national chief executive that really isn't compos mentis. We don't actually seem to have any kind of coherent action or even capacity for action at the federal executive level at this point. There seems to be no form of collective agency that's sort of operating nationwide. And that means that functions that might normally have been considered federal functions, or that might normally have been pursued by federal agencies, are to an increasing, seemingly ever-growing degree, having to be addressed by state instrumentalities and city instrumentalities, right? States and cities are having to do what federal agencies would normally have done. But the problem there, of course, is that, as just mentioned, and as all of you who are regulars here at Mac and Cheese know, state finance and local finance are constrained in ways that federal finance is not. One way, then, of looking at the new facility that the Fed has been offering since the beginning of April, that I'm about to sort of lay out, is as sort of giving expression to the Fed's recognition that states and cities are sort of filling in for or substituting for federal agencies, and thus trying to make available to them a mode of financing that can be more properly thought of as federal financing. That's to say, not financially constrained or financially limited, but rather only limited by the imperatives of national monetary policy, which we hope would not become inflationary or deflationary. And as we know, the danger of its becoming inflationary is unbelievably remote and has been for way, way, way over a decade at this point, at least outside of the financial markets. So here's the facility then, at least kind of in broad outline. And then I'll say a bit about why it doesn't really live up to this particular potential that I'm sort of encouraging us to sort of think of it as having, in the hope that we might then force the Fed to make it more what it's meant to be. So what the Fed has essentially offered to do as of the beginning of April is to buy financial instruments that are issued by states and cities directly from those states and cities. There's no requirement, in other words, that they first sell them on the so-called open market to private sector buyers from whom or from which the Fed itself might then subsequently purchase them. The Fed is, in essence, saying, look, we will purchase your paper directly, which is basically like saying we're going to lend to you directly. Again, there are a lot of constraints that we're going to have to talk about in a moment, and talk about why those are problematic and what we have to do to remove them. We'll also talk a bit about what would be even better than the MLF or than community QE at all. But before we get there, just a little bit more about what this MLF means, or what it means to purchase this state or municipally issued paper. If you go to a bank and take out a loan, as you guys know, one of the final acts that you will perform before that loan transaction is consummated is you will sign over a promissory note, and you'll give the bank that note, and then the bank at that point will make available to you another kind of note known as a Federal Reserve note, or it's electronic or bank deposit equivalent. So what you're doing is you're trading your personal promissory notes for federal promissory notes, i.e. Federal Reserve notes. That's essentially what a loan transaction is. It's a temporary swap of one kind of promissory note for another. So in a certain sense, you can view any offer by the Fed to purchase issued paper directly by the issuing entity, be that a state or a municipality, as something equivalent to that. It's basically lending to that particular institution. It's basically trading Federal Reserve notes or their equivalent for municipal notes or for state notes, right? Whatever the issuing authority is. And in so doing, what it's doing is, of course, monetizing that form of debt in the same way that a bank is monetizing your promissory note when you take out a loan from it. Now, that's the basic idea. Where things get interesting, of course, is when you get into the particular details, right? What are the terms of the loan? How long is the money lent for? Is there some sort of interest that has to be paid on the loan? What's the periodicity of that? Are there additional fees or rates that are sort of piled up on top of some sort of garden variety interest rate and the like? If the answers to all of those questions are that, yeah, there are all of those things, but they're very, very liberal, right? So, for example, you can borrow for 10 years or for 20 years or for 30 years, or if you can only borrow for 6 months, but the loan can be continually turned over every 6 months, basically refied or renewed every 6 months, then you've got a really long-term loan, of course. If on the other hand, you've got to pay it back after 6 months or 12 months or 24 months or whatever, then it's a sort of shorter term loan. Sort of similarly, you can imagine rather high rates having to be paid for the privilege of borrowing this Fed money, or very low rates being paid. And you can imagine penalty rates being added on to the regular interest rates on the theory that, well, we want to discourage you from borrowing too much from the Fed, or you can imagine us not imposing any such rates at all. So there are lots of sort of dimensions of variability, you might say. And along each of these dimensions, the loan or the loan terms can be thought of as being more liberal, that is to say more sort of generous, more forthcoming, or less generous, right? Less forthcoming, more constraining, in other words. Now, here's where things get a little bit troubling, it seems to me. So the terms as we currently find them are, in fact, ridiculous. They're punitive. They are out of sync with the purpose of the MLF, or the Municipal Liquidity Facilities, as it's being called. They're out of sync with the purpose of the MLF as a sort of form of federal financing for state and municipal entities that have become de facto federal agencies dealing with a national problem, namely a pandemic. The lengths or the terms of the loans are still too short, even though they've grown longer quite steadily ever since the introduction of the MLF about 2.5 to 3 months ago. And there are penalties that are assessed, and furthermore, the eligibility requirements for what level of government or what sort of entity can have access to this facility are still too restrictive, even though, again, they're rather less restrictive than they were to begin with. Now, I want to say a little bit more about what I mean by all of that, partly by specifying the senses in which they're too restrictive, also by specifying a little bit more the senses in which they have liberalized over time, even though not enough. But I think it'll be easier to kind of see what's at stake or why this matters if I say first a little bit more about what alternatives to the MLF we might have hoped for, and indeed we might still push for, and indeed some of us are, and many indeed of us are still pushing for. So, if you really wanted to fund cities and states as federal agencies in the sort of fullest possible sense, you wouldn't be talking about lending to them from the Fed or from any other federal instrumentality at all. You would just be talking about federal grants to them, right? After all, when a federal agency, most federal agencies that operate with appropriated or congressionally appropriated funds don't borrow from any federal entity. They're simply funded federally to do their federal jobs. So if we really wanted to take the analogy of cities and states being in effect kind of commandeered into sort of federal agency type actions seriously, we would say, well, just fund the bloody things in the way that you would normally fund a federal executive agency if we actually still had those, because if we actually still had a federal executive in the White House right now. And indeed, that's one of the things that is before Congress now. As you guys know, the House has already passed what's known as the HEROES Act, which would be a kind of successor to the CARES Act, which would quite substantially fund, in the form of just outright federal grant money, state and municipal actions that are aimed at both pandemic response and at responding to sort of collateral damage that's been caused by the pandemic itself, right? In the form of supporting businesses, supporting housing, supporting continued rental payments, mortgage payments, and the like. Now, as you guys also know, the Senate has to take up the HEROES Act for it to be passed. That's going to occur, right? The debates or the actions that occur in the Senate on HEROES will occur next month. And it's still a bit of a moving target to sort of figure out what's likely to happen there, partly because facts on the ground are changing so quickly, right? So for a while there, when people seem to be talking as though, hey, we're coming out of it, we're almost recovered, at that point, Republicans and corporate Dems were sort of saying, well, this HEROES Act might be a little too generous. We maybe ought to put in a bunch more conditions before we are so open-handed. But now, of course, in the last week or so, with the numbers once again spiking, partly in places where they had previously spiked and then gone down, and partly in places that had never really been struck to the same degree yet, people are beginning to think once again, oh, maybe we're not actually over this hump. Maybe you actually have to do something to address the problem rather than thinking it's simply going to sort of dissipate or go away of its own accord after a few months. So suddenly Republicans and corporate Dems are talking a little bit less about, oh gosh, we better, maybe we got to turn on, sort of close the tap a bit or draw in the reins a bit, or maybe we should require as a condition of giving more funding to the states some kind of waiver of any possible liability that any private sector firm might face for some sort of COVID-related injuries of one kind or another. So it could well be, right, at the moment at least, the prospects for actual outright federal funding of states and cities via the HEROES Act are looking much better than they did even a week ago. And this is one of those kind of good news and bad news things, right? I mean, it's good news that that's the case, but it's bad news. I guess it was that which is making it the case is bad news, right? But in any event, that I think is the top thing to push for and to hope for, right? Not lending to states or cities, but granting, okay? Now, assuming if it turned out to be the case that granting is not going to be enough, or that not enough will be granted, then we would be talking about lending to cover up to cover the remaining bit. And then the question becomes, well, how best to lend, right? What should the terms of the lending be, right? Well, another possibility to sort of make the terms of the lending as liberal as possible would be for the Fed to use what's called its Section 14.2 authority. So I'm basically referencing Section 14.2 of the Federal Reserve Act. And under that particular section, the Fed is able to purchase municipal issuances, and there aren't a bunch of categorical restrictions that are placed on that authority in the way that you find in Section 13.3, which I'll return to in a moment, and which latter section is relevant because that's the section under which the MLF has been devised. But returning for the moment, or sticking for the moment with Section 14.2, the only real significant restriction that 14.2 imposes as a kind of means by which the Fed could lend to states or cities is that it basically limits the scope to 6-month paper, right? It's basically very, very short-term lending, right? It's quite literally sort of liquidity support in the sort of standard financial market understanding of the term liquidity here. And so, it really wouldn't be suitable because of that, even though it would be suitable thanks to, the lack of other restrictions. But that means also that a very simple fix would be to do either or both of the following. You could either just remove that 6-month restriction from 14.2 altogether by legislation, or you could have you could legislate, or maybe the Fed would even have the authority to promulgate a rule to the effect that the 6-month requirement is suspended during times of declared national emergency under the National Emergencies Act of 1976, which has indeed been invoked, as you guys know, in which then you might say, okay, so now we can purchase even longer term paper, or think of that as the silver. So the gold solution might be just to eliminate the restriction altogether. The silver solution might be simply to suspend it. The bronze solution, let's say the bronze medal, might be taken by an announcement by the Fed that it will simply keep rolling over the 6-month debt, right? It'll basically just refi it every 6 months, making it or rendering it almost functionally equivalent to a sort of term-free or termless loan. Not quite that, of course, because we would still have to worry that the Fed at some point will now start saying, okay, we won't roll over anymore. And we would be operating under that sort of cloud of uncertainty, and how serious that would pinch, I suppose would be partly a function of, the alternative, which is, how seriously does it look like the pandemic is going to pinch? If it's all a matter of, choose your poison or what's comparatively worse, then that might not be that terrible. But again, it would be less than optimal, let's say. But you can imagine that, and so that's maybe, needless to say, another thing I've been pushing for a while. Some of you guys probably know Ellen Brown over at the Public Banking Institute. She's been sort of a champion of using the 14-2 authority like this for many years, actually. I mean, way back when she called on the Fed basically to sort of use 14-2 authority to finance municipalities that were getting into trouble, including during the last crisis 12 years ago, and advocated that the Fed simply just roll over the 6-month debt for as long as need be. And again, I think she was right about that, in the sense that it would be a kind of a plausible fallback if you're not going to just directly fund. But that said, again, let's remind ourselves it's much more sensible simply to fund directly. In any event, so that would be the 14-2 option. The Fed has thus far shown no interest in doing that, notwithstanding the advocacy of Ellen for many years, the advocacy of me and others who have sort of joined her in that call over the last 3, 4, or 5 months. A lot of people, just as a kind of a quick sidebar, a lot of people sort of saw this coming even in February, even in late January, when it was clear that a pandemic was going to emerge, and private sector municipal financing markets, basically the so-called muni markets, were beginning to show signs of volatility and skittishness on the part of the investors. And so there was already worry emerging, and the financial press was kind of full of it in February, to the effect that ordinary private sector financing of municipal operations is not going to be functional. So people were really beginning to talk about what shape a federal intervention might take even before the lockdowns began. And quite a few of us were saying, well, if it's going to be the Fed, then 14-2 might be preferable to 13-3 if we could just get the 6-month restriction either removed or suspended, or just in effect ignored through constant rollover for as long as need be. In any event, Fed didn't listen to any of that and still has shown no particular interest in it. And that means what we're stuck with is falling back to the so-called Section 13-3 authority that I referred to a moment ago. Now, 13-3 is often referred to as the sort of exigent circumstances provision in the Federal Reserve Act. So the idea is this is the Federal Reserve Act's sort of express recognition of the possibility of emergencies of one kind or another that might extraordinary new program to sort of assist or to aid or to help get us over some sort of a hump, And the 13-3 authority was probably most, famously used, at least within our lifetimes, last time around, right? A lot of the new facilities that the Fed developed or innovated back in 2008 and 2009 in response to that crash and crisis were innovated under the Section 13-3 exigent circumstances authority. So the idea here is, typically what happens is the Fed will sort of establish an entity. It'll call it a special purpose vehicle or an SPV. It's basically a legal trust or a legal entity that has the legal capacity to hold assets and to sort of receive assets and to pay out money, basically to operate like a buying and selling entity. And then this particular facility or this particular entity then will sort of be what it's empowered to buy and what it's empowered to do is all going to be determined by a term sheet, as we call it, which basically set the terms pursuant to which this entity will operate. And so a bunch of these, as I noted, or a number of them were innovated back 12 years or so ago. And what the Fed seems to have decided to do, at least for the time being, this time around, is to say, well, that one's kind of fresh in our memory. We still kind of remember how to do that. We still have people working at the New York Fed where these things are administered who worked on those earlier ones in 2008, 2009. So let's just do the same damn thing again. But this time, in addition to operating facilities of this sort on behalf of banking institutions or other financial institutions, and in some cases, other private sector institutions that aren't technically financial institutions, let's do a little bit for the cities and states as well, because the muni markets appear to be freezing up, or at least they seem to be imperiled with that prospect. And maybe we can kind of loosen up those markets and help out the cities and states if we sort of run a facility kind of like one of those of 2008, but that instead of buying up, bad mortgage instruments or whatever, taking them off of the books of troubled financial institutions, will buy municipal paper. So the Fed more or less tipped its hand to the effect that this was going to be forthcoming late in March, shortly after the CARES Act was passed, actually within a couple of days at the most, depending on how close you were to the sort of inner circles. I mean, the word was getting out quite early on. And the initial anticipation was that the Fed was going to do something quite radical in the sense that it would buy municipal paper directly from the cities or states and not simply off of the so-called open market, which was itself a kind of something of a game changer, or at least a significant difference from previous practice. But it was also anticipated that this would only be available to states as such, maybe to really large cities, but no others. And that it would only basically be buying up 12-month paper, right? So basically the maturities would double relative to the Section 14.2 eligible instrument maturities. So everybody was thinking it's going to be 12-month paper, and that'll be maybe something of improvement. The Fed sort of pleasantly surprised people by coming right out of the gates April 9th with the express intention to purchase 2-year paper, right? 24-month paper, which is of course longer term. It's getting beyond liquid, but it's still short term. So the announcement was it'll be 24-month paper, and then the eligible issuers will be all of the states, and then any county within a state with 2 million or more in population, and then any city in the state with 1 million or more in population. Well, that, of course, pretty well ruled out just about every city and county in the country. It was mainly a state thing, right? I mean, obviously, New York City could benefit, Los Angeles could benefit, but cities like Buffalo in New York, pretty sizable city, wouldn't have qualified. Within, almost immediately, once the announcement was made, April 9th, quite a few of us sort of seized on this as representing at least a good, sort of something with considerable potential, at least relative to what the Fed had done previously. Still nowhere near enough, but the thought was, A, it's certainly better than nothing, and B, because this is such uncharted territory for the Fed, because this is so new, the Fed is going to feel a little bit, kind of a little lack of confidence when it comes to sort of getting this thing up and running. And so it might be open to quote unquote suggestion or advocacy by cities and states, especially if it's forceful, right? So what I argued at the time, I got a tip off, I guess it was a day or two before the official announcement came out as to sort of what it was going to look like. So I sort of wrote up some stuff that I just kind of had on deck to sort of release as soon as the announcement was made. And then I released, the announcement was made, so then I released this stuff. And so what I argued right off the bat, and others joined, was that the cities and states should jump on this. And they should immediately be liaising with the Fed and pressing the Fed on the terms, and to push it right from the get-go, to liberalize the terms even further, and to really push the envelope furthermore in coming up with the kinds of local or in-state programs that might be developed and then financed with that particular funding. The thought being that we can turn this into something that would warrant the name of community QE, even if the MLF as up to that point constituted, didn't quite live up to that sort of exalted or sort of hopeful sounding name. But Steve, of course, knows Steve even sort of titled one of our chats a couple of years ago, Metabolic Optimism, right? So Steve knows that I'm sort of optimistic by metabolism. I tend to kind of seize on what looks like the best potential and then try to push it as hard as possible until it turns out that it's completely futile. And, at this point, I think it's closer to futile than it looked 3 months ago, but it's still not quite there yet. So we might still, make something good out of this. But in any event, so what we did is, immediately right out of the gates, we said, okay, look, this has great potential, but here's some things that really ought to be done to make it better. Lengthening the terms of the loans, lowering the population thresholds that would qualify a city or other entity for Fed financing, and to eliminate anything in the way of a rate, an interest rate, let alone a penalty rate, that basically it should be interest-free lending, the next best thing to just outright granting. And, to our pleasant surprise, also I should note that the optimist in me was not only pushing for that, but was also predicting it. But, interestingly enough, I was sort of predicting that, we'll probably get out from, the current 2-year maturities to 3-year maturities probably by early June, maybe sometime in May, and that we'll eventually get up to 5-year maturities by, I don't know, later June or July, and then I predicted that the population thresholds would be knocked down in half within about a month or thereabouts. And to the pleasant surprise of many of us, with just barely more than 2 weeks after the Fed first announced it, right? So the first announcement was April 9. By April 27, they put out a renewed term sheet, and they did better. They did better than our most optimistic predictions or most sanguine hopes, right? So they immediately extended out the maturities of the eligible notes to 3 years, to 36 months, and we're still in late April. We hadn't even reached May yet. And they didn't cut the population thresholds in half. They cut them into a quarter. So now basically any county with 500,000 or more people would qualify, and any city with 250,000, i.e. 250,000 or more people would qualify. Now, again, that's still not good enough, but it was a significant liberalization in just over 2 weeks, and a much more rapid liberalization than even the most wildly optimistic person in the room, who I guess was me, had predicted, right? So that all looked pretty good. And so things were looking kind of pretty as we entered into May. I was thinking, we might just have this thing what we want it. We might have this thing being or becoming what we want it to be before summer. But since then, it's been a bit of a sort of a mixed story. So there has been continued liberalization along some dimensions, and so there's still a good news piece of the story if the story we're talking about is the trajectory or the trend. On the other hand, there's now a significant bad news element in the trend as well. And that is that the Fed has not shown any indication of any sort of willingness, or even willingness not even to consider, let alone to do, anything by way of eliminating interest rate charges, eliminating penalty rate charges, or eliminating the current requirement that an eligible issuer have a bond rating, right, from some rating agency. And this is unbelievably absurd for multiple reasons. The less dramatic one, but the one that's immediately probably obvious to all of you guys, just on the basis of the last few minutes, is that, again, if this is a way of federally funding city and state entities that are doing federal jobs, basically, because we don't have, again, a federal executive any longer for the time being, it doesn't make sense to be charging rates at all or requiring that they get bond ratings before they get any kind of lending. Again, we don't do that with federal agencies. Why would we do it here? To make things even more ridiculous, however, the penalty rate idea, it's very clear where that comes from. So just to sort of step back for just a half a second, usually, the Fed facilities that were pioneered in 2008, 2009, from which this MLF sort of derives, are sort of classic lender of last resort type facilities. And the theory, some of you guys probably already know, the theory behind the lender of last resort is that there are some financial entities out there, some financial institutions that get themselves into trouble. They engage in recklessly speculative behavior. They don't engage in productive investment. They do various stupid things or venal things. They get themselves into trouble, and we would like to let the bastards fail because it's their fault, it's their problem. But we can't, in some cases, the theory goes, because if they failed, they'd take a bunch of innocent third parties down with them. They would impose what the economists call negative externalities. They are what the finance types call too big to fail. And that's essentially the nature of the too big to fail problem. It's that an institution is able, in a certain sense, to hold itself hostage and make you rescue it on the theory that if it goes down, it takes you with it, or it takes others who are innocent with it. So the way we deal with this too big to fail problem is the way that was sort of first, I guess, canonically articulated by the great British commentator Walter Bagehot back in the 1870s. Some of you have probably seen or heard of, if not read, his book Lombard Street, which is essentially a kind of a charitable interpretation of what he took to be standard Bank of England practice in dealing with volatility on the British financial markets back in the Victorian period. And the idea was that, okay, if you really do have a legitimately too big to fail institution that's failing through its own recklessness, so that you would really rather not save it, but you kind of have to because it's going to take third parties with it, then what you do is you go ahead and provide it liquidity support to rescue it, but you impose a penalty rate to make it kind of painful to the institution, so as thereby to sort of avoid the so-called moral hazard problem, right? They won't want to get themselves into trouble again, because even though you're helping them out, they're still going to feel pain. And if they're still going to feel pain, maybe they'll be less likely to get themselves into the same trouble next time. You can sort of liken this to co-insurance or deductibles that insurance companies charge, right? The theory of insurance is that, well, we need it, it's a good thing, but it too can raise a moral hazard problem. You might not take good care to sort of protect yourself or your property if you're insured. So the insurance company imposes a deductible, or basically pays only a certain percentage of your loss, so that then you feel some pain too if the so-called insured event occurs, and then you're less likely to have to use the insurance, to get yourself into trouble. That's the way you deal with the moral hazard problem in insurance markets. And the theory behind the lender of last resort function with a penalty rate is that. Now, fast forward back up to right now, as distinguished from 2008, when we were dealing with, in some cases at least, allegedly too big to fail financial institutions. There's no sense under heaven, right, in which a city or a state can be viewed as being in any sense responsible for the pandemic that's been sweeping across the country, nor can any city or state be held responsible for not having been able single-handedly in advance to deal with what is a national pandemic, not just a state or city problem. Nor is there any reason under heaven to think that the cities or states had any reason to anticipate and be prepared for the complete pratfall taken by the federal executive. Basically, they thought we had a president, right? They thought we had a federal executive, but we don't. And I don't think that it would make sense to say that cities or states should be faulted for that. And so what I'm basically saying here is we're not dealing then with the too big to fail problem. We're not dealing with a profligate or recklessly behaving financial institution that has gotten itself into trouble that we wish we could let fail, but we're simply only going to rescue because innocent third parties would go down with it. We're actually dealing again with public instrumentalities that are operating on behalf of the public and doing the best they can to deal with the problem they had no reason to anticipate, and certainly had no way to prevent happening, right? Because again, that's something that the federal government has traditionally done. It's why we have a federal government. It's why we have a constitution rather than the old Articles of Confederation that the Constitution replaced. So in that case, right, to impose a penalty rate on cities or states that you rescue is it's basically not a penalty. It's actually a ransom, right? It's as though the analogy would be like we just threw somebody who doesn't know how to swim into a lake, and then the guy's drowning because we threw him in the lake, and then he asks for a life preserver, and we say, well, we'll throw you a life preserver on condition that when you get out of the water, we get to horsewhip you. Why? What would be the point of it? It's just gratuitous punishment. So penalty rates are just completely out of place here. In effect, what's happened, the Fed is engaged in a kind of category error. It's a bit like asking what color is the number 7, right? What should the penalty rate be for a city or a state? There should be no penalty rate. It's not that situation. It's not a lender of last resort function that the Fed is engaging in. And the Fed itself ought to be able to see that, for one thing, because the very fact that the maturities of the eligible loans are already out to 3 years and still anticipated to get out to 5 years before the summer is done is itself an indication that this is not standard LOLR stuff, because standard LOLR stuff is liquidity lending. That's very, very short-term lending. We're talking about longer-term. So what we're doing now is I've been working with a bunch of state governors. I'm not governors, what I'm saying, treasurers. We've put a letter together that looks like it's going to be signed by somewhere around 37 or 38 state treasurers, calling on the Fed to make a certain number of specific liberalizations to the MLF. And among them is the complete dropping of the idea of penalty rates, also just dropping any kind of rate at all. It should treat this again as federal financing for the fulfillment of federal functions. And dropping the eligibility requirements, the population thresholds even further. Basically, there should not even be a population threshold at all. What we're arguing is that the test should be any entity that is performing a federal function because a federal instrumentality is not performing it should simply be financed for as long and as much as is necessary, or as long and as much as the existing federal entity, if it did exist, would be funded, right? Basically, the Fed should, in other words, bite the bullet and say, look, instead of this weird, incoherent mishmash of a program that looks on the one hand like federal funding for the carrying out of federal functions, but yet on the other hand looks like an LOLR sort of facility of the 2008 type, instead of kind of maintaining this weird, incoherent mix, it should just bite the bullet and say, this is one of those things. It's not the other of those things, and it's not even both of those things. It's only one of those things. The one thing that it is federal financing for governmental entities that discharge federal functions. And that means no fees, certainly no penalties, means no population thresholds or anything of that sort. All you need is that the entity that's doing it has to be legitimately performing the task, and it has to be performing it because there's not some obvious alternative in the form of a federal agency doing it. And that would be the way to do MLF. The final point here, sort of ridiculous thing about the way MLF is being administered at the moment is that it's being administered entirely out of the New York Fed, right? It's all housed over on between Liberty Street and Maiden Lane, right down here in Lower Manhattan, literally 2 blocks from where I'm talking to you right now. So I'm talking to you guys from my Lower Manhattan place, which I actually bought 10 years ago to work at the New York Fed. Lots of old friends and colleagues are still there. They're wonderful people. I've never known smarter or more serious-minded public servants in any venue in my entire life. So I think the world of the rank and file at the New York Fed. And if anybody could do this out of one institution, it would be them. But the antecedent to that conditional statement, if anybody, is simply negated. It's not the case that any one entity can handle this. This function ought to be distributed over all of the regional feds and then some, because if you think about it, our cities and states are distributed over an entire continent, right? We've got cities and states out in the Pacific Ocean. It's called Hawaii, right? We've got all over this continent, we've got cities and states. What sense does it make to think that a small number of people, the total staff at the New York Fed is about 2,800 people, and the number that can be devoted to MLF is a tiny, tiny fraction of that. The thought that that tiny fraction of people could administer federal financing for every city and state in the union across the entire continent and out into the Pacific Ocean is simply absurd. It's also profoundly unfair to the personnel at the New York Fed. It puts much too much on them. Now, again, you can kind of see why the Fed might have just kind of stumbled into doing it this way out of habit. All of the programs on which the current MLF is sort of based, or by which it's been inspired, were designed to help out large financial institutions, most of which are situated or headquartered right here around Wall Street. And so, sure, yeah, if all of your facilities are designed to help out big banks, I guess it makes sense to administer them out of that one regional Federal Reserve Bank whose jurisdiction covers those particular banks. Now, whether it made sense, of course, only to help out big banks in 2008 is an altogether different question, and we know the answer. It's no. Given that that was what they decided to do in 08, you could see why they would have done it out of the New York Fed. But the Fed is now effectively admitting that that's not what we're doing now, because MLF is about cities and states. So it ought to be administered out of all of the different regional feds. Each regional fed can deal with cities and states in its particular territory. So a sort of final thing that I've been calling for in sort of has both a particular form and a more general form. The particular form is administer the bloody MLF, not to mention all of the Main Street lending facilities. There are 4 small business lending facilities that the Fed is administering too. All 4 of those so-called Main Street or small business lending facilities that the Fed's going to administer, and the MLF should be administered out of the regional Fed banks. That's the sort of particular call. And then the more general call that I've been making, and this, I've got a paper out there that I think Stephen knows about, I think Virginia knows about this too, called Spread the Fed, just says, look, why don't we just permanently do this, right? Why don't we have all of the regional Feds permanently handling primary market financing and small business financing and city and state assistance financing henceforth, and let's administer all of that out of the various regional feds, which would actually bring the Fed into something a little closer to sync with its original mission, right? I mean, a lot of it, as established in 1913, right? People who don't know much about the Fed or Fed history or America's own kind of weirdly ambivalent history with central banking might not be familiar with this, but those who are familiar with America's kind of ambivalence about central banking will know that the whole idea behind the federal, they know why it is we have all of these distinct Federal Reserve regional banks. And they know it has to do with the fact that we, in 1913, were a little bit uncomfortable with the idea that there would be one central bank located in one part of the country, basically sort of disproportionately solicitous of the interests of one industry that's also located in that part of the country, namely big finance up in the Northeast. And so that's why we have regional feds. And, it's beginning to look to me, and I suspect to a lot of other people, like maybe we ought to remember that and maybe use our regional feds as regional feds to help out cities and states, which are, again, distributed over a continent. So let's redistribute the Fed over the continent as well. Final point in that connection is because the Fed was established in 1913, when the overwhelmingly greater part of the national population was east of the Rockies, all of the Federal Reserve regional banks tend to be concentrated there, right? We've got 2 Federal Reserve regional banks in the state of Missouri, but we've got 1, maybe 2, depending on where you count Dallas, west of the Rockies, right? You basically got the San Francisco Fed and the Dallas Fed out there, and everything else is east of the Rockies. So it doesn't really make sense to have that particular distribution. But note how you can fix this not by saying, oh, we're going to take away the Cleveland Fed or we're going to take away the Richmond Fed and move it out further west. Just make more bloody feds, right? Why not establish like at least 5 more regional Fed banks west of the Rockies while leaving the ones that are east of the Rockies intact? That would actually make more sense because it's not like the people on the eastern part of the country have all just picked up and moved to the west. The reason that the west is more populated now relative to the east than it once was because it was kind of empty before and now it's not. So, more people out west than more Federal Reserve banks out west, but you don't have to limit it in any of those on the east. And furthermore, I mean, if there's one institution in the world that literally cannot run out of money, it would seem to be the Federal Reserve. And so it's not as though it's going to be somehow just too costly for them to establish and run and staff and pay the staffers of some additional Fed banks. So a kind of a final sort of general proposal that I've sort of been pushing now that kind of grows out of this, or at least is sort of related to this, even if it's also distinct, is this idea of spreading the Fed or distributing the Fed again, and basically distributing the functionalities across the regional Feds. And with that, I guess I should stop and take a breath and see what you guys are thinking in response to all of that.
Well, thanks, Bob. A lot of good information there. I am just wanting to give everybody a quick bit of instructions here. There are a lot of people on this call. If you're going to ask a question, please let's make sure it's not a compound question, and let's also try to remember our audience is regular Jane and Joe activists. All right, with that, let me just ask you, Bob, one quick thing, because I know this is going to come up probably at some point. Obviously, you're talking about adding additional Fed banks, and people are under this sad, I would call it a Ron Paul infused belief system that makes them think that, the Federal Reserve is this creature from Jekyll Isle versus the nation's central bank. Can you please just explain how we might add 5 additional Fed banks, given the structural nature of the relationship between our federal government and its central bank?
Sure. Yeah. So I think, to establish literal additional regional Federal Reserve banks would require some amendment, I think, to the Federal Reserve Act, which might not be a bad thing because there's some other things I think we probably ought to change in the original Federal Reserve Act as well. But, even short of that, the Fed has considerable discretion when it comes to opening up branch offices of existing regional Federal Reserve banks. And so you can imagine the Fed, even on its own, beginning the process of taking on a greater presence west of the Rockies than it currently does, even before any particular statutory amendment. Now, next thing to note in this connection is, it really gets down to what's the actual fundamental point of or fundamental function of a Fed. I think that the function is kind of morphed over time. Some functions of the Fed are kind of temporally invariant in the sense that some version of them has been envisaged right from the get-go. But other bits of Fed functionality have kind of morphed over time. So let me, just to keep things simple, let me just identify two functions. One will be like the classic example of the one that's kind of invariant, and the other will be the one be a classic example of one that I think is morphed and that ought to be morphed back. So, one function that any central bank has is what I always call, what Steve knows I always call the money modulatory function or the credit modulatory function. So the idea is to try to regulate the quantum of credit out there, to put it really in really kind of crude intuitive terms, to regulate or modulate the quantum of credit out there in relation to the supply of goods and services that can be purchased with that money or credit money, right? To maintain some kind of sort of synchronization between money on the one hand and what money can purchase on the other. On the theory that if you've got, quote unquote, too much money or too great a velocity of money circulation relative to a given stock of goods, that's the classic predicate for inflationary pressure developing. And then by the same token, if there's inadequate money or credit money out there relative to a growing supply of goods or services, then you've got the danger of deflationary pressure emerging. And so one way of thinking of the central bank is as the kind of, it's sort of regulating the level of the fluid, so to speak, in the sink. If it's flowing out more rapidly, then it's got to turn the spigot on so that there's more flowing in. And if it's flowing out more slowly, then it's to kind of slow the tap if you're trying to maintain a basic level. And, again, that's a very crude way of putting it, but you get the idea. Sort of intuitively, this sort of money modulatory function seems to be a kind of an invariant across central banks across time. It seems to be basically what they're about. Now, that was the case in 1913, and it's the case now. I think it was less articulately appreciated and understood in 1913 than it is now. In 1913, I think people were probably thinking more in terms of liquidity than in terms of credit aggregates. But over time, it didn't take long. Basically by around the mid to late 1920s, I think the understanding of the role of credit in determining a money supply and the understanding of the constituting of money credit or credit money aggregates in an economy as a whole was beginning to be well enough understood that I think people were already beginning to think, well, yeah, that's that's probably a better way of describing what a Fed or a central bank is for. So there's something that's kind of the same now as it was then, even if it's better, in some ways better understood now than it was then. An example of something that maybe was different then than now, and it was probably better then than now, is that I think that the regional Fed banks in 1913 and thereabouts were viewed as being meant to essentially aid with the kind of smooth development and growth of productive capacity in every different region of the country as it stood in 1913. So it was understood that, this is largely private sector activity, but it was also understood that private sector activity could only proceed smoothly if that public good, which is known as the credit money supply, was adequately sort of supplied and modulated at the regional level. And in that sense, you could sort of think of the regional Fed banks as kind of like national development banks, kind of regionally based national development banks. Now, again, it's a little bit of a stretch because insofar as the founders of the Fed system were thinking in liquidity terms, they were basically imagining only one kind of problem or one kind of quote unquote market failure that might impede or sort of gum up the smooth regional development of regional economies nationwide, whereas indeed there are many more kinds of impediment. But nevertheless, even if they only were imagining one kind of impediment, at least the basic purpose they were kind of clear about. Yeah, we want to enable smooth development in productive capacity and general opulence in every region of the country. And it was understood that different regions of our country had sort of different economies, right? That their economies, although of course linked under one sort of national jurisdiction, nevertheless showed significant intra or interregional variation, as they do to this day. They probably were more variable then than now, but they're still quite variable. So in that sense, you can sort of think of the original vision of the Fed is as a kind of decentralized or federated national development banking institution. Now, today, there's a sort of, I think we're sort of faced with a bit of a paradox when it comes to national development. On the one hand, I think we're savvy enough to realize that there are many more quote unquote market failures or sort of sources that impede smooth development, sort of ongoing economic development, than we realized back then. In other words, we realized that liquidity is not the only problem, and that's the good news. But the bad news is we seem not really to think of the regional Federal Reserve banks as having much to do with dealing with those other kinds of impediments. We tend to treat them more as like basically regional located monetary think tanks and compilers of statistical information concerning, particular key indicators of particular regional economies that all jointly constitute the American economy. But we don't give them a great deal of functionality when it comes to making credit available, when it comes to seeing to it that smaller businesses or businesses with other sort of socially beneficial attributes are adequately financed. It's almost like we're kind of afraid of letting the Fed do that kind of thing because that's too political, and monetary policy is supposed to be sterile and free of all that kind of nonsense. But what that effectively does is it then turns those regional Fed banks into, again, kind of just slightly glorified think tanks that are regionally focused, and then basically focuses most of the real action that the Fed takes in New York, right, or on the FOMC, which is, as which you guys know, the New York Fed has a kind of primacy on, in the sense that it's the only regional Fed bank that's permanently on the Federal Open Market Committee, along with the Fed Board, whereas all the other regional Fed banks kind of rotate through the FOMC on a periodic basis. So my thought is that it would be kind of cool if we could kind of bring together, on the one hand, the modern recognition that there are more impediments of a financial nature to smooth, ongoing, full employment development than just liquidity problems. That's a modern understanding that I don't think was adequately held by political or policymakers 100 years ago. Bring that understanding into sync with the regionally federated structure of the Fed, and thereby make the regional Feds into something like regional development institutions. And if we took one further step, and this is something I'm advocating in other work that I've been publishing lately, if every state had at least one public bank of the sort of Bank of North Dakota variety that would liaise with the sort of relevant regional Fed bank, we could have a kind of fully developed circulatory system, you might say, for public financing. And, it wouldn't have to take the form of just lending, right? We could have, direct distribution of granted money because, there's no better fuel injector, you might say, of monies, even when the monies are granted rather than lent, than a financial institution that's used in that way. Right? So, that's if you want to sort of a kind of a rough idea of sort of what I'm sort of imagining with sort of the mad scientist cap on, or sort of further Fed reform going forward, even beyond the current pandemic, and bringing the Fed closer into sync with a kind of people's finance and people's money arrangement. I think that something like that might actually be doable, in the sense that it's a perfectly feasible extension from the existing architecture that we have in the form of the Fed, but at the same time is radically different enough as far as the functionality is concerned that it could make a real difference rather than just being a kind of window dressing thing.
Great. Hey, thank you, Bob. I really appreciate that.
Sure.
Folks, I'm going to open this up. Remember, try to be considerate of the others on here. Do not take up the full time if you can help it. And Virginia, I'll let you go ahead and do your thing.
Oh, okay, Steve. Well, I'm happy to have you do it. Jeffrey asked me to ask his question for him. And it was, what do you think of using the post office as a federal means of banking? And then Christina asked a sort of related question about whether all of this will pave the way for public banking?
So, I think when you think about banking and then postal banking, it's worth, I think, keeping in mind sort of two maybe distinct functionalities that anything that we would call a bank tends to discharge, right? One is the sort of determination of where money ought to be flowing. Right. Basically, it's kind of gatekeeping and saying, okay, what are good possible prospective uses of federal money, whether that federal money be lent or whether it be granted, right? Sort of on the ground project evaluation, you might say. And that's part of what a bank's credit department is meant to do. It's meant to determine how worthwhile a particular proposed lending transaction is on the basis of the likely payout of the transaction. And if you have a non-profit institution, like a public banking institution doing this, it's much better than if you have a private institution doing it, at least in one sense, in that there's no profit maximizing imperative. All you want to do is, presumably maybe break even in aggregate, and even recognizing and allowing for certain losses on individual transactions. But, just basically some kind of long-term sustainability of the distribution of federal money. That's one function, right? Another banking function, of course, is just offering a spot or a place where people can make their deposits or take out their money or, check up on their balances or maybe get a bit of financial advice from somebody, or what have you. Now, if we distinguish between those two things, probably the idea of the postal bank might not be altogether helpful for the first of those functions. It might be, but it would definitely be a significant departure from what the post office currently does, right? You don't have loan officers at at post offices, and you don't have credit departments or, anybody who's doing financial evaluation of that kind. So that would require a significant addition to the functionalities of the post offices. And we might decide that it makes more sense simply to create new credit determining or credit evaluating and credit granting or fund distributing federal institutions that aren't in post offices at all, but they're just sort of freestanding new entities in their own right? There's no need to put it in the post offices necessarily, but there might be if there are certain areas of the country, for example, where it's just, it's a lot easier just to use an existing brick and mortar building that's federally owned or federally operated to sort of house that sort of operation. So I'm kind of agnostic, I guess you could say, about postal banking from that point of view, which is just to say I'm perfectly fine with it. I see no reason not to do it that way, but I also see no compelling reason to do it that way if you could actually just have federal credit distribution offices that are freestanding that aren't in post offices, right? You could just open them up in cities anywhere, put them in behind storefronts or whatever. Every regional Fed bank could have branch offices at various strategic locations in cities and counties that people go to sort of seek credit to finance particular projects that they have in mind that are staffed with people who are expert at this form of evaluation in a way that current postal people are not. Going then to the sort of the banking, the sort of deposit taking, deposit giving, withdrawing and so forth function. There too, I think it's fine to do that at post offices, but it's once again kind of unnecessary. There are other ways to do it. So, for example, if you've got people who want to keep dealing in cash, in coin, or paper cash, there's no reason you couldn't require every bank that runs an ATM machine to make that ATM machine also usable by people who are keeping money in federally managed accounts, right? So let's say that the Fed or the Treasury Department offers every American business and individual an account, right? So you have a free account that you can maintain with either Treasury or Fed. I'll tell you a little bit more about the Treasury plan that I have in mind for this in a moment. But in any event, if the Fed or Treasury is maintaining a system of this kind, then the question is, okay, well, how do you do depositing and how do you do withdrawing? Well, one way to do it, again, you could do it through post offices, but in another way is you could just say every ATM that exists has to be accessible for the same purpose, right? It has to link up to the Treasury or Fed administered system of publicly maintained accounts. And it's a condition of your licensure, right? If you have a national banking license, or what we call a national charter, we can simply add a condition that you don't get a national banking charter unless your ATMs and teller windows are also usable by people who don't want to bank with you, but want to bank with the Treasury or the Fed. Then you wouldn't need to do anything at all to post offices. You'd commandeer all the existing private sector banking facilities for this purpose and just say, you got to offer this too, or else you just don't get the license. And I don't think we should feel uncomfortable about doing that. Nobody's ever suggested that banking is a matter of right. It's a privilege. You have to have a license to do it. And so we could simply add this as a public service requirement or condition to the license. Another way to do this, which I think is probably the way of the future, as more and more people grow more and more comfortable with electronic payment media and paying through their phones or other devices, is you can sort of circumvent or just avoid brick and mortar type banking altogether, right? I could make my deposits into my account through my phone. I can make payments off of my phone. My phone would be basically tapped into the account that I maintain with the Fed or with the Treasury. And then I wouldn't need the post offices or the private sector banks or their ATMs. My guess is that for some time to come, we are still going to want paper cash, if for no other reason than to have some medium that doesn't require people to have access to certain sensitive information of ours. But insofar as that's the case, we will want some sort of physical places at which currency can be deposited and withdrawn. But again, it's fine with me if that's done in post offices, but I don't think there's any necessary link there. You could easily enough just commandeer the private sector banking institutions to do that. Tying that into public banking more generally, to the second part of the question, I love that question, partly because it kind of segues nicely out of the last spiel I was giving in response to Steve's query before. So, the long-term vision that I think we ought to be drawn to, or that I find at least attractive, and I think a lot of other people do as well, including friends of this program and friends of yours truly, is that every state would have some kind of public bank that would then have a kind of a direct nexus with the appropriate regional Fed bank. And these public banking institutions, or these state public banks, basically this Bank of North Dakotas that every state would have, would be essentially be focused on a few things. First of all, they would offer themselves fee-free banking. Banking should be thought of as a public utility, obviously, at least in an exchange economy like our own, or a commercial society, as we call ourselves. Basically, a payment platform or a payment mechanism or medium is an essential public utility in any such society or economy. So that ought to be publicly available, and you can do it again through the Fed or the Treasury, but you could also do it at state level by state public banks, or you could do both, right? There's no reason you couldn't have both of those. And so I'm quite gung-ho about that. Relatedly, when it comes to the credit dissemination function, or the sort of determination of what sorts of potentially productive projects ought to be financed and on what terms, there you need sort of specialized evaluators of projects. That's a classic banking function too. But we ought to have, at least every state ought to have at least one, it seems to me, such institution that's operating on a non-profit basis, that's not trying to make money off of doing this. The reason, the argument that's usually given for profit-motivated banking is that, well, then there's a sort of constraint, right? The loan officers or the credit disseminators or the funding disseminators are not sort of too profligate. They're not throwing money after projects that aren't going to add to the productive potential of the economy. And insofar as they do that, then they're going to be adding money that doesn't find a counterpart in more production that can absorb the new money. So there'll be inflationary pressure generated over time in the long run. The way we avoid that, supposedly, is we make sure that the money only goes to projects that are likely to pan out and result in greater production and productive capacity, thereby creating the means of absorbing the new money itself, right? So it's kind of self-liquidating in that sense. And the theory is that only the profit motive will sort of, prompt people to do that, will sort of impose that discipline on the loan officers or the deciders as to the allocations of the funding. But that's just false, right? There are other ways to sort of assure a certain kind of discipline, or a lack, at least to prevent overly profligate funding of the inflationary sort. Indeed, the entire toolbox of macroprudential tools, both the familiar ones and the unfamiliar ones about which I've been teaching for 15 years at law school and now in business school, are best viewed in that light, even if the users of them, that's to say, even if the regulators who use them don't always realize that that's what they're doing, or that that's one way of viewing what they're doing. But in any event, I'm all in favor of public sort of fund allocating alongside, if not indeed even in place of, private sector fund allocating of that kind. And this would link up really nicely, I think, with a spread Fed. We might have here, in a sense, an incipient development sort of nervous system or plumbing system or sort of blood circulatory system for a fully public form of finance economy wide that wouldn't be driven by a profit motive, and that would be all about sustainable and equitably shared growth in productive capacity and material well-being over time.
Larry, I don't know if your question was answered. Do you want to ask him? I know it was about also about post offices and postal banking.
The question I really have is because of the right-wing attacks on the Postal Service and the fact that they're trying to privatize everything, which is extremely frustrating, and the fact that people get their medications and everything through the post office. Now, with the 75-year pension provision that they have, is there a way for the MLF to actually step in and prevent them from going belly up?
Probably not. There are definitely lots of ways to step in and prevent them from going belly up. The MLF, however, I don't think would be one of them. Basically, just because it's sort of been framed and constructed and conceived right from the get-go as a means of offering inexpensive, or at least relatively inexpensive, federal money for state and municipal entities, right, to finance them. And since the post office is a federal entity, I just don't think it would qualify by terms. That being said, if Chairman Powell of the Fed had a little bit more spine even than he has shown himself to have, and I don't mean to suggest that he doesn't have plenty, because he's stood up, I think, to Orange Julius in a way that I think a lot of people have been pleasantly surprised by over the last few years. But if he really wants, if Mr. Powell would really like to step up to the plate and defy Mr. Trump, I don't see why the Fed itself couldn't just establish a separate facility to help to fund the Postal Service. Now, there might be legal constraints that I'm just not aware of. I'm not an expert on the sort of the law of the Postal Service, other than to know that it's constitutionally provided for specifically, and that the founders had in mind a system that would kind of bind the nation. It was a kind of a solvent, right, to kind of help to, through a kind of an early primitive communications infrastructure, to make us one society, right, with one sort of public mind through the mails. That's all sort of implicit in the constitutional provision for a postal service. So I know that much, but I don't know, what sorts of specific constraints there might be in federal law when it comes to where the Postal Service can get money from. Taking that, keeping that disclaimer in mind, I don't see any reason, in principle at least, why you couldn't have the Fed just develop on its own initiative an emergency funding facility for the Postal Service itself, to basically rescue it over the next few months until such time as we have somebody in office who doesn't want to destroy it, assuming that we, get to that point.
Thank you. Lon, you had a question. What Dr. Hockett is saying makes perfect sense to me, but how do we get a government, both executive and legislative branches, that would move forward on these ideas for the regional development banks?
Yeah. So this, in a way, this nicely implicates a number of conversations that Steve and I have had on this program and in other fora that Steve and I have conversed in. So, there's a lot of reason to be pessimistic, maybe needless to say. But there are some reasons to be optimistic. I mean, the obvious reasons to be pessimistic are that, obviously the guy who's currently in charge, seems to be perfectly happy to watch, federal capacity just continue to sort of dissipate and wither away. And, the guy who the Democratic Party has somehow selected to, kind of run up against him, has a track record that doesn't suggest, significant. Well, it doesn't suggest that he's going to be, particularly wonderful either. So those are the obvious reasons, right, to be sort of a little pessimistic. One reason maybe to be optimistic, and again, Steve knows that I always seize on even the slightest excuse to be optimistic, is that it does appear that the Biden team, this might be window dressing, but it might also just be partly sincere. They do seem to be wanting to have some kind of joint Bernie Biden creation of the platform that comes out in August. And so, as you guys know, right, they've put together this kind of reconciliation committee that basically is divided into a number of subject areas, and then each subject area has a subcommittee associated with it, with two chairs, one named by Bernie and one named by Biden. I've been doing some work with a couple of those subcommittees, and I can say that the people who have been named by Bernie, as you guys already know, are fantastic. But I can also say that they're being listened to, and they're definitely adding their recommendations to, or proposals to, the mix of things to be discussed and hashed out in forming the platform. Now, if all of that turns out to be all in good faith, right, rather than, again, just window dressing to make it look like we're making nice with the progressives so that at least some of them will come out to the polls instead of saying, oh, it's no different, so I'm not going to go vote. If there's any sincerity at all in this, then there's at least some reason to think that modest versions, obviously very unsatisfactory versions, but at least sort of initial steps along these directions might be taken, and at the very least might then serve as sort of bases on which President Ocasio-Cortez, when she takes office in January of 2025, can actually build, right? I mean, an interesting historical example that some people might find some hope in here is, they're basically the overwhelmingly greater part of the most innovative New Deal reforms and institutions were really basically scalings up of pre-existing models that came from two sources. One was the state of New York, where Governor Roosevelt and his state industrial commissioner, Francis Perkins, basically put together a New York New Deal in the late 1920s and early 30s, before 32, I should say. And then when Governor Roosevelt became President Roosevelt, and when State Industrial Commissioner Perkins became Labor Secretary Perkins, the first woman ever in a presidential cabinet, they formed a New Deal that was partly just an expansion to the national level of these innovative things, including Social Security, that they had developed at the state level. The other source, the other big source of New Deal programs and plans, believe it or not, was Herbert Hoover. Right? So Hoover was actually a pretty smart and creatively thinking guy. He was even kind of renowned for that when he was younger, before he got kind of old and conservative. And he was still, I think he still had a lot of kind of creative capacity, even when he was older and was president. But his problem was that he was very, kind of timid. He was conservative in a kind of temperamental sense rather than an ideological sense. And so he started all sorts of interesting programs at the end of his time as president that were actually great ideas. They just weren't big enough. He just didn't do them to scale, right? He just said, oh, let's give this one $25 and see what it can do, And so Roosevelt comes in, sweeps in and says, hey, that's actually a pretty cool idea. Let's multiply its funding by 10 times, or let's lever up the funding of it by 100 times and then see what happens. And a lot of things worked that way. A lot of the most successful things in the New Deal were in effect invented by Hoover, but really didn't do anything while Hoover was president because he just didn't take them seriously enough to give them adequate funding. So, if you fast forward now, let's say that Alexandria becomes president in the 2024 election, which is the first election she'll be old enough to run in, and she takes office in 2025. Well, if we have the kind of platforms put in place, even in sort of Herbert Hoover, kind of half-ass ways by Biden, who's not only kind of cautious like Hoover, but also less creative than Hoover. But if he's creative enough, partly thanks to there being enough Bernie people as part of the team, that he at least puts these kind of kernel type or sort of incipient versions of what could be really cool things if they were just bigger in place during his 4 years, then, we might actually have something cool happen in about 4.5 years from now. And by that point, by the way, we'll have probably a pretty well permanent progressive majority in the country, because as we know, each new cohort that comes in is more sort of forthrightly left-leaning, and the ones who are more the kind of Clinton-type Dems are kind of becoming a smaller portion of the population. So I feel like if we can get us over the hump of the next 4 years and not just sort of have everybody be dead through contagion or through burning of the planet or something, if we can somehow hold on for 4 more years, we might see real massive changes beginning in a really big way in 2025, assuming that they don't start sooner than that.
Oh, thank you. Okay, I just have to interject about your metabolic optimism. One of your interviews with Steve for Macro and Cheese, I just finished listening to it, and I called Andy and I said, the strangest thing happened to me when I was about halfway through. And he said, you were about to vote for Elizabeth Warren, weren't you? You basically had me convinced that she was kind of a socialist. So
yeah, I had myself convinced too, and boy, did I turn out to be wrong. Right? I mean, I had to do a sort of mea culpa, man. I mean, Steve knows. I mean, I just held out for the slightest sign of hope I was going to seize on, and Steve and I talked about it. We had wonderful chats about it, both on Mac and Cheese and offline. And as Steve knows, I even defended her, or at least I defended the possibility of her still, being all right. But boy, January 15th, when she pulled that Hillary Clinton move with CNN and sort of, bushwhacked Bernie with that, he somehow doesn't think women can win the presidency or whatever. I mean, man, that was a real, kind of a mental, I don't know how to describe it. But, that was really a dejection causing 24 hours. But part of being metabolically optimistic is, within 24 hours, you just think, well, I was wrong about that. Well, and move on to the next thing that we might actually be hopeful about,
Hey, Bob, I'm so sorry. I want to ask you sort of a follow-on to this, and I think I'm going to echo, because I've been in what we might call in fuego today, absolutely going for the throat of one Joe Biden. And not because I like Donald Trump at all. I despise, in fact, I hate him more than I hate Biden. But here's my question to you, strategically speaking, because all the stuff that we're talking about is conditional on not just the president, the plumbing, if you will, of the government. And that means all the appointments, that means all the downstream, down ballot folks that are sponsored, so to speak, by the president, who signs off on those people, and you name it. And one thing that I question, and I'm not going to put you on the spot, but I want to ask you, because what you're talking about, the things you're talking about, are not so much conditional on the POTUS, so much as Congress and other factors working together to put, because Congress and the Senate could easily pass bills if they would work together, which they won't, but they could pass bills and put them up to the president and put him on the spot to show that he will veto them. They're not doing that. So this bad orange guy is not even getting the chance to veto them. So my question to you is this. If I have 4 years of Donald Trump, there's no way Pence rivets any nation. There's no shot of Pence ever getting elected president. He's an easy one to crush, in my opinion. Out of all of them, he's the easiest one. That said, us united for 4 years with all the pussy hats and the Angies and Emily's listers, staying engaged for 4 years, taking a break on brunch, sticking it out and fighting, as opposed to caving in and allowing the Hillary Clinton machine to reattach its tentacles back into the bowels of government. We're not just talking about 4 years of Biden. We're not even talking about 8 years of Biden. We're talking about 4 years of Biden and 8 years of Kamala, and then all the tentacles we have to unattach to get. So in my opinion, I'm looking at this through a different lens. It's got nothing to do with Trump is a buffoon. But if the president, the bully pulpit, he goes around, starts endorsing him, he's the de facto head of the party. The people, the ballot, the folks that get pushed forward, get the funding, get the support of the DNC are not the progressives. I'm just wondering what, strategically speaking, especially with climate change having an expiration date on it, what is our better strategy? And I know you're the metabolic optimist here, but my take on this is, and I'm really not being a pro-Trump guy in any way, shape, or form. In fact, I'm completely anti-Trump. But I think that we're stronger together. and the only way I see us being strong together is being united against Trump. Otherwise, I see these folks checking their stock portfolios and going to brunch and having $15 lattes and not paying attention anymore, checking out. And then all of a sudden, us progressives are the crazy guy with the John 3:16 sign on the corner of the street instead of being a mass movement. So I'm just curious what your take on that is.
Yeah, no, it's a great question, my friend. So, once again, the standard disclaimer here sort of applies in the sense that, I might be completely off about this. I'm basically about to offer two interrelated empirical conjectures, right? Two guesses about where things are going that might be wrong. I was clearly wrong about Warren, for example, when you and I talked about her, and my optimism about her turned out to be unwarranted, if I can sort of pun. So I might be. So I don't want to seem to be more confident in what I'm about to say than I actually am. But here's how things look to me. It seems to me this is more likely than not to be the case. I think I'm probably a little bit more optimistic about where the Democratic Party is going and is inevitably going to go, maybe than you are. And maybe simultaneously a little bit more pessimistic about what 4 more years of Trump might mean than you. So if we start with the matter of entrenchment, like what gets, the idea of the sort of renewal of the tentacles, as you put it, which is a great metaphor for this. One really dangerous set of tentacles, precisely because they're legally tenured, so to speak, for life, is the courts, the judges. And, Trump has appointed a ton of them already. And he basically, the people he's appointing, and here I'm just basically trotting out my sort of lawyerly or law professor sort of role. I can tell you that, these are really unbelievably bad judges. These are really horrifying. These people are completely unqualified. They're incompetent. Most of the time they're mad. They're insane. And the thing about them is they have life tenure unless we can actually impeach them. And so there's a real significant, I think, danger of real hard, really tenacious tentacles being put in place and strangling our judicial system, which is an entire branch of our federal government, if this dude sort of stays in office any longer. And that's not to mention, of course, the danger of just complete, like some kind of a coup that he can, this continued destruction, which of all federal capacity, which seems to be accelerating in its pace. So I'm really more pessimistic about Trump now than I was 4 years ago. You might remember, Steve, that 4 years ago, I was even ready to give him something of the benefit of the doubt, because I thought, well, it's true that our trade relations have to be reexamined. And it's true that, major infrastructure investment has to be undertaken. And it's true that we have to sort of revitalize manufacturing and not just, think that we can be a burger flipping economy. And he's talking about all those things. And his victory speech in November was so surprisingly conciliatory that I thought, well, maybe all that kind of trollery that he was engaging in was just a campaign ploy just to get certain people to vote for him. But he's actually going to turn out to be a humane, sensible person who's breaking with the neoliberal agenda. Also, he talked a good game about, how Wall Street doesn't make anything. And so he's really not going to be, prioritizing them. But all of that seems to have turned out to be, and he actually seems to me to be kind of, mentally just declining really rapidly. But now here's the irony, right? Obviously the same thing is happening to Joe Biden. And I mean, at least as far as cognitive is concerned, right? In some ways it seems to be happening to him even faster, at least when it comes to at least the capacity to talk, right? To even just to sort of utter sentences, which does make one, worry and wonder. And as you and I have talked about before, I mean, my God, the track record of Joe Biden as a legislator and just as a political person, I mean, it's just awful. And you'll remember I was pretty tart and was basically everything. And I couldn't mention the guy's name without just spouting invective for a long, long time until sometime this spring, probably. So, I'm not like a fan, and I don't want to sort of downplay or understate the danger I think that he himself represents. But I'm nevertheless a little bit more optimistic, I think, about where the Democratic Party is going than I think maybe you are, in the sense that it seems to me that the Clinton types really are not, they're basically leaving at a more rapid rate than they're being replaced. You know what I mean? So that their numbers are dwindling. I mean, Kamala is one of the younger ones, of course, and so she'll be around a bit longer. But I think that the Kamala types and the Mayor Pete types and so forth, again, maybe I'm ridiculously optimistic here, but they seem to be pretty rapidly heading toward minority status within the party. And, I might be extrapolating too sanguinely from our wonderful electoral results here in New York last night, where, all the best progressive candidates won. And now we've dumped Eliot Engel in the same way that we got rid of Joe Crowley when Alex won 4 years ago. 2 years ago. And maybe New York is not representative here, but there's good news from other states and jurisdictions as well. So I'm really beginning to think that the party is moving much more rapidly in that true progressive direction than we had realized at first, and that by 2024, the Kamalas might very well be a real desperate minority. And if that's true, then the tentacles that they would represent wouldn't be quite as tenacious as the sort of life tenured judges that Trump would appoint. So I'm doing a kind of comparative nastiness analysis, I suppose you could say. But basically, I have very little hope for anything much good coming out of a Biden administration. I think a lot of bad would come, but I also have the sense that the trajectory of things in the Democratic Party is that the Biden problem is just disappearing kind of as a matter of just demographic development, whereas the Trump problem, it's also going to disappear gradually as a demographic matter, but life tenured judges who are like appointed when they're 35, which is what Trump seems to be doing, could be with us for a good 50 more years. And that's really going to totally suck, because then we're just going to have to basically, change the Constitution or something, or do massive impeachments of judges, which I'm certainly fine with doing, but historically it's not precedented, and so it might not be something to invest a lot of hope in. I keep saying that, the first day that, I used to say at least the first day that President Sanders takes office, January 20th of 2021, the first thing we should do is initiate impeachment proceedings against Kavanaugh on the Supreme Court. But I don't think that's going to happen with Biden.
No, I think Biden might be right of Kavanaugh.
Yeah, in some ways, or in some matters, I think he probably is. At least when he knows what where he is.
I wanted to say, even though I may be trending further, pessimistic, and I do appreciate the candor. You always give a detailed analysis, and for that I really appreciate, because you clearly, it's not, if you hear what I said, and most people don't bother reading what I say, they just hear what they want to hear. If you hear what I actually said, I'm trying to give us a 4-year, let's get well and then get AOC in there, as opposed to let's bottleneck it because the Democrats will primary their own. They are not going to run a counterinsurgent candidate when they have the White House. So if they have that, so these are the things that I'm terrified of, especially because, climate change is either real or it's not. If it's real, and I believe it is, I've been fighting like it is anyway, then we don't have time for a conservative to do nothing. Nothing will fundamentally change, his favorite line. That in and of itself means that we die. So it's either real or it's Memorex. I mean, I don't know which one it is because obviously the urgency is not reflected. I don't see the same urgency. So to me, that's terrifying. I don't want to be an alarmist. I feel terrified.
No, I don't think it's alarmist at all, Steve. I mean, first of all, even if I turned out to be right, so I think that what I've just said, I think, is what's likely to happen, but I don't think it's likely in the sense of like 99-1 or whatever. I think it's more like 51-49 or 55-55. So I mean, I have to take your 49 or your 45 or whatever quite seriously. And you raise a really important particular point in this connection, and that is, in a way, at least backhandedly, the importance of the running mate. Because as you say, right, if it is a younger running mate who's in the Biden mold, then, as you say, even if Biden does indeed retire for 2024, which I suspect will happen 2 years, I don't think he's even going to be functioning within a couple of years. The question then becomes, all right, is the heir apparent his VP, or is it somebody altogether new? And I keep sort of speaking happily that, it's going to be AOC. But that wouldn't be true if Biden had a younger running mate who, basically everybody was happy enough with that they were complacent, So, in a way, I mean, my ideal would be like if Biden chooses somebody else who's kind of old like him, but maybe is, a woman, maybe a woman of color. How old is Barbara Lee? Is she in her 60s? I mean, if it could be if it could be somebody who's more progressive than he is, but also older, so that the VP would be likely to retire after 4 years too, so that we can say, okay, completely fresh new ticket for the 2024 race with AOC at the top. That would be, probably ideal, but I don't know. Does anybody have a good idea as to who he might be looking at most strongly?
All I see is Kamala. That's what I see over and over again is Kamala. I saw some push for Stacey Abrams, but I think she's still hugging it up with Bloomberg. So I'm telling you, man, if I wanted to be a Republican, I'd still be a Republican, right?
Yeah. I mean, I don't want to wish a short life on anybody, but I wish that, if we're going to be Harris or Abrams, I wish they could be like 77 also, I mean, the thought of somebody who's like, in their 40s or 50s, who then is a plausible candidate in 2024 and thereby lengthens the duration of the Biden-esque or the Bidenian captivity even longer.
I'm stealing that. That's forever the name, Bidenian captivity. It's the best line I've ever heard in my life. All right, I've hogged up enough time. Let other people jump in. I just knew that we had so many people involved in that particular discussion that I figured it was everybody had some interest in hearing it. That's all.
Oh, yeah, I'm glad you raised it, Steve. Thanks.
All right, Virginia, go ahead.
Thank you, Steve. I totally agree with you. Okay, Sam, go ahead.
I had a question about strategy and tactics for using general strike. What are your thoughts on that?
Yeah. Good. So I tend to think, I guess like a couple of thoughts on that. For one thing, the idea of, or the sort of feasibility or the likelihood of actually being able to mobilize around a general strike seems to be more hopeful, or the prospects look better, let's say, for that than they have for a long time, it seems, at least at present. And that's partly, that's sort of good news in a way, but it's one of the things that makes it the news, I think, is that there's so much bad news, right? I mean, basically things have gotten so much worse so dramatically, or that the degree to which things are worse has come to be more and more revealed, to the point where I think we could actually, we're a lot closer to the capacity to mobilize general strikes than we would have been even a year or two ago. What I'd be tempted to do is to sort of build up to it by basically taking advantage of the current mobilization in steering it toward sort of next things to sort of demand, right? So the protests in the wake of the murder of George Floyd, and then the other murders that happened shortly thereafter, and then some of those that happened shortly before, have been, kind of a wonderful thing to behold. And I think I'm probably anything but alone. I bet lots of us are thinking now, what do we do to kind of keep this energy going now that it's there? And of course, at the moment, the next thing is the tearing down of the statues that seems to be happening all over the place. And I understand that. How could I not? And, in many ways, that's to be applauded as well. But it's really tempting to think, what we ought to do while we're at it here is, why don't we call the Secretary of State's office in any state where the Secretary of State has shut down the polling sites in African-American neighborhoods? Why don't we call that a monument? Why don't we tear that down? Or why don't we, go and bang on its doors or do a sit-in strike there? What if, like, for every two people who's currently protesting by a monument, they made an agreement, one will stay and keep working at the monument, and then the other one will go over to the Secretary of State's office in Kentucky or Georgia or, other states that haven't gotten as much attention for this but are just as criminal, and just, basically storm, take over, bang on the doors of, camp around, strike tents around, have a Hooverville around those offices and demand that new polling sites be opened at once or that polling sites be restored at once. That sort of does a couple of things, it seems to me. First of all, it capitalizes on a mobilization that's already underway, right? So you don't have to kind of start from the ground up. If people are already activated, they're ready to go. Second, the connection between that and systemic racism and police murders of people of color and the like is pretty obvious. It's just it's in many ways an equally insidious manifestation of ongoing Jim Crow. And sort of thirdly, it has an actual, a real sort of direct payoff, at least in potential, where you might actually get more votes counted. Whereas the statue stuff is important, but it's a little bit more symbolic maybe than immediately practical, as important as it nevertheless is. So I'm tempted to, sort of take steps like that next and see what they yield. And if they yield real fruit, then you can imagine then carrying it even further to the point of full general strike if it comes to that, if that turns out to be necessary, which indeed it could well turn out to be. But I'm sort of hoping it won't.
Oh, Christina, ask your question.
Hi.
Hey.
So
Hi.
let me go back to the chat. So I have friends that have their pulse in what's happening in the stock market. And usually they don't call it a recession really unless big corporations or big industry or Wall Street is affected, because I feel like we're probably in a recession right now. It's just that the big guys are not feeling it. I imagine that, that the threats of recession is still looming. I don't know how one can even prepare for something like this, or if the items that that are being looked at by the feds or any of the financial wing of the federal government can help even assist with anything of the sort. What are the things to look out for? Because my friend says that they've heard that the feds are going to stop propping up the Wall Street during the pandemic, and they heard that the stock market is a little bit more inflated. But I don't even care about that. So I wanted to get your insight on these, because it's I always wonder what the neoliberal wing is planning, in this sense.
Yeah. So I mean, that's a great question. And in a way, kind of it's sort of the elephant in the room in a way. And in some ways, it's certainly one of the most important questions to be addressed. And I think we just have to bite the bullet and say, look, we're in a depression already. We're not, hovering near a depression or hovering near a recession. We're in a depression by most of the, most sensible and salient measures. And the real key has to be on, how to get out of it. And to answer that question, I think we have to look at certain indicators that typically aren't looked at as with the same intensity as they require. So, first of all, we have to ask, how many people don't have regular income coming in? And don't have any prospect of regular income coming in from private sector institutions or entities that might have previously employed them. And, the numbers and the percentages are much higher right now than they were during the actual Great Depression. And the only thing that's keeping people somewhat afloat now who fall within that category is federal money on the one hand, and sort of federally sponsored or encouraged suspensions of payments that they might normally have had to be making on the other hand, like rents and so forth. And as you guys know, a lot of those suspensions of rental and mortgage payments are coming to an end at the end of this month. People are suddenly going to start making monthly payments again in July. And that's going to be a massive shock. And, that's going to make things much, much worse than they've been up to this point. And we're going to have to extend those suspensions. That means even further. And it means also we're going to have to, I think, immediately start, make sort of quasi-permanent and make regular disbursements, federal disbursements to substitute for missing incomes for people. Now, that's going to sound initially like a kind of temporary UBI type thing. But, all of us here, I think, can also recognize that would represent an opportunity that we could actually morph that pretty quickly into something more like a job guarantee, right? Because we could say, well, look, all right, now that we've established that the federal monies are going to be being dispersed, let's see if we can't now figure out some things that we can do together to sort of basically maintain some form of productive activity or socially beneficial activity that would, among other things, could sort of absorb some of that additional money, but also enables us to sort of be working together to kind of restore capacity to our society and to our economy, and just to be acting together in concert again rather than socially isolating, right? So, it seems to me that a really helpful thing that we could all be doing right now, with the help of people who are way ahead of us on this score, like Pav, to start thinking what should the next steps be when it comes to particular public function, sort of public contributions in the form of activity that people can engage in, that we can think of as sort of federal jobs that are kind of counterparts to federal monies. Now, I feel a little ambivalent talking this way because I think at this point it might still be premature to be. I don't want to seem to be saying let's make them work for the money or whatever, right? Because I think that it's a lot of people really are faced either with actual incapacity right now because they're ill or because loved ones are ill or have been stricken, or they're faced by the risk thereof, right? Because we still don't have adequate testing and contact tracing going on. We still don't have adequate production of PPE underway. There's still a lot of personal vulnerability that people face to the pandemic itself, right, to actual infection. And so I don't want to jump the gun on saying, let's get people working now for this money, because otherwise they're just layabouts and they're going to get into bad habits and they're not going to want to work anymore, like Larry Kudlow's been saying. I think that's all bullshit. I think it's, we don't want to force people into sort of dangerous situations any sort of unnecessary. But I think, actually, we don't want to force them into that at all. But what I'm really getting at here is that we have an opportunity here, and if we're now recognizing the principle of federal disbursements to people, not just as sort of charity or whatever, but as a matter of keeping an economy functional, well, then it's only one more half step to say, well, why don't we just make that a federal guarantee? That's always going to be the case. And that means a federal employment guarantee when things are kind of closer to normal than they are right now. So it's like a kind of temporary UBI when we can't really expect people to be working in close proximity to one another, at least until such time as we actually have enough PPE production and enough capacity to deal with the actual pandemic, which we just don't have because this administration has done nothing in the last 3 months to fix that, even during the time that we've been isolated. When that was the whole point of the isolation, I thought. But so we don't want to rush that. But once it's possible to do that, it seems to me that we've kind of got the principle half established, at least, out of which we can build a kind of permanent job guarantee functionality and a broad public recognition of that as not only a legitimate function of our federal instrumentalities or our federal government, but a kind of necessary function, right? The word I was actually looking for is an indispensable function of our federal government. So that would be something I would like to see sort of grow out of this or develop out of this. We're sort of halfway there, it feels like. Because the hardest part is, as we know, or at least one of the hardest parts, is just to get people to sort of recognize it as something that's not just like wacky, so out of the box that it's just like Nowheresville. It's just like crazy. It's zany. It's like science fiction. We know now it's not science fiction. We see it happening. I mean, we see the disbursements, and it's not enough. And we're beginning to recognize that we're going to have to do more of that, and we're going to have to regularize it and make it kind of permanent for a while, for a lengthy period of time. But since people sort of are beginning to see that already, well, it's not really that much more to get them to see that. Hey, well, why can't we just have an employer of last resort function? That's a part of our standard operating procedure. FDR pushed for it, after all, in the Second Bill of Rights. MLK pushed for it. Coretta King pushed for it even after MLK had died. It's not really that zany. And now we actually see it as a living reality in a certain sense, or at least we're sort of we see it in a kind of incipient form right now.
Well, I love that you say we're halfway there. I don't know how you see it that way, but it's kind of like Elizabeth Warren being halfway to socialism.
Right. I mean, halfway toward recognition of it is what I mean. We're as far as actual implementation, we're not even anywhere near halfway there. But I'm thinking more in terms of like, there seems to be a broad public acceptance now that it's not unacceptably radical to have the government sending checks out to lots of people. So now, as long as, and that's the biggest hurdle, right? Like, what? You want the federal government to send checks to people? Keep your hands off keep your government hands off my Social Security. But I think people are at least, they recognize that as a kind of, not just a possibility now, but even a kind of compelling need. And so conceptually speaking, or sort of conceptual, acceptance of the concept wise, I think that we're much farther along than we were like 3 months ago. And
right. So the pushback is not that horrible as it would have been if we didn't have the pandemic and there was no need to do any of these assistance to get resources to the hands of the right people. Yeah. Thank you very much. I'm glad I asked the question.
Thank you, Christina. Okay, one last question is from Jabari. Go ahead, Jabari.
Hey, Bob. How you doing tonight?
Hey, Jabari, how are you, man?
All right. Yeah, I know we had a little interesting conversation a couple of days ago about
on Messenger. Yeah. Great to hear your voice.
But anyway, what I was just thinking about you're talking about community QE, and if the Fed I was wondering if the Fed were to make conditions on that, could we sort of use that as a backdoor way to get into the job guarantee, saying, well, yes, we're going to pay off your loans, but you have to do certain things, and start using that as the basis to create a job guarantee from the back door. And then perhaps once you see evidence of it and people see it, then they'll be like, oh, it's not so bad. Then it'll be easier to pressure kindness.
That's totally brilliant, my friend. So I think that is entirely possible to do. And I think it would be entirely fitting to do. And I think it would be very easy to justify doing it, essentially for the reasons that you just said, right? The only thing I would add is we could say, well, look, the Fed could say that, look, it's doing this for a specific purpose. That purpose is best understood in terms of providing a kind of resilience or a kind of long-lasting assistance that will be sort of self-sustaining once it's in place. And the best way to do that is to essentially to see to it or try to ensure that the recipients of the funding use the funding to put in place kind of permanent structures that can continue then even after the Fed assistance ceases. So it'd be a kind of rough equivalent to the Fed saying we're offering the money to teach people to fish rather than offering the money to buy fish, that kind of thing. Although I hesitate a little bit to use that because that way of talking about things sometimes gets a bit condescending and so forth. And we want to be careful that the Fed doesn't, seem to be taking a kind of condescending posture towards cities or states. But that being said, if the Fed were to say, look, the way to make this actually worthwhile is to make sure that it's used to put in place more permanent structures that persist even after the Fed assistance is no longer needed or underway. Seems to me that's perfectly legitimate. I've been sort of trying to do something like what you're suggesting here, sort of from the other side, as it were. So what I mean by that is I've been consulting with a bunch of city governments. On the one hand, I'm kind of lucky that I know a bunch of city government types from my little adventure about 10 years ago with this eminent domain plan for underwater mortgage loans that I came up with that I was sort of selling to the cities back during the last crisis as a way of basically writing off mortgage debt so as to prevent foreclosures, to keep people in their homes and so forth. And that plan, which you guys can read about if you just Google my name and then the phrase eminent domain, there's just a ton of stuff in the press about it up until about 2014 or 2015 when I was still doing it. That got me into pretty close relations with a lot of city government types and also a lot of activist groups, housing advocacy groups, community advocacy groups, and so forth on the one hand. And then my prior history with working with the Fed on the other means that I'm pretty friendly with, or even former colleagues with, a lot of regional Fed folk on the other hand. And so one of the things I've been doing ever since the MLF was announced was sort of using this sort of lucky happenstance that I happen to have connections on both sides of what looks to be a necessary set of transactions now between city officials and state officials on the one hand and Fed officials on the other, to kind of bring them together and to kind of basically to liaise between them and to bring them into kind of regular contact and communication. Now, one of the things that's grown out of that sort of ongoing effort that's been going on since early April now is sort of helping city and state officials kind of figure out particular uses that they might put the MLF money to. And one of the things I've been suggesting is that, well, look, there's this wonderful opportunity right now where you can say, okay, if you're going to seek some MLF funding and part of it's going to be used to help some local businesses out, why don't you condition that assistance that you're giving to local businesses on those businesses distributing shares in themselves to their employees so that their employees become part owners of those firms and not just, rented labor, not just people who are paid wages. Why not do that, right? Why not also, any state that's going to receive MLF funding is going to want to allocate those monies in sort of rational and not overly duplicative ways, in kind of sensible, efficient ways throughout the state. That means they're going to need some sort of coordinating body. Each state is going to need some coordinating authority to determine how to disperse the MLF funds. Why not create in every state a coordinating body like this, which could then be the nucleus or the sort of the germ of what could then be grown into a full public bank in that state? Because after all, one thing that a state public bank does is to allocate funds, right, from the public fisc throughout the state. Bank of North Dakota is a great big fund allocator throughout North Dakota. So if you created in every state something called a coordinating body that's basically allocating MLF funds, you've got, in a sense, the foundation for what you just add a couple of functionalities to, like you add an electronic payments platform and digital wallet system to it, and you now have electronic banking free of charge and electronic payment systems available to every resident of the state, and it can be associated with this coordinating body. At this point, it's really beginning to look a lot like a kind of virtual version or a digital version of the Bank of North Dakota in every state. And, so there's a lot of stuff you can build around the transaction that is the receipt of MLF funding by a state or city. You can build around that transaction lots of additional infrastructure, like things like public banks, and sort of very long-term socially beneficial conditionality arrangements to sort of bring about a transformation of the way in which we conduct productive activity, like, again, getting more employee ownership, for example. Likewise, you can use MLF funding, this is another thing I've been pushing with some of them, to establish community land trusts, which can then buy properties, particularly in blighted areas, and then kind of fix them up, and then convey the ownership of them to renters co-ops. And so you might have a lot of people who currently are renters who have to pay rental fees to, kind of screwy landlords. Instead, they might be paying themselves in the form of their own rental co-ops. And this could be done through MLF funding, especially if the MLF terms are extended, right? So if you have 5-year loans or 10-year loans, you could use it for that. The only restriction is you have to be able to sort of couch it in terms of, or justify it in terms of revenue anticipation. But it's very easy to make a case to the effect that measures of this kind would, over some reasonable period of time, 3-5 years, begin to generate much more prosperity, much more economic activity, and thus much more public revenue for that state. And so you could actually call this plausibly a revenue anticipation issuance, right? And even if you couldn't do that, if the MLF funding enabled you to free up certain existing funding that you're doing for other things and simply replace that existing funding with MLF funding and then redirect that existing money toward these other things, then again, you can do all kinds of transformative stuff in changing the basic economic arrangements and the basic sort of property ownership and rental arrangements across cities and across states, all built on this MLF plan, so or facility. So the potentialities are really great, and it's just like you, I think, Jabari, to have immediately seen, it's basically grasped that right from the get-go. I mean, it seems to me that you and I sort of think alike in the sense that there's a sense in which I think we might be kind of natural entrepreneurs of a sort, right? Because this is a kind of an entrepreneurial thing. It's not a profit-making entrepreneurial thing. It's a kind of social wealth growing entrepreneurial thing. But, you see something like this and you think, what can I make of that? We might be able to make that into something kind of cool, even though it looks kind of crappy at the moment with the given terms, but just a few little tweaks or adjustments and a few creative framings of the revenue anticipation uses to which we want to put the money. And there's all kinds of really cool stuff that we could do with it.
This has been terrific. It doesn't look like there are any more questions, which is good. You are just the best. It's just a pleasure having you.
Bob, thank you for real. I mean, I don't know if people realize what a, absolute embarrassment of riches we have by having these guests on, but I just want to give a round of applause to Bob for helping us, folks try to make sense of a very crazy world that is not what we do for a living, most of us, and so some of these things are tricky and scary. And Bob, I really appreciate you taking the time to explain these concepts to us.
Always a joy.
Well, I appreciate it. So anyway, I want you to hear this because this is important. We are about to unleash a whole bunch of things, and unfortunately, we don't have enough horses in the stable to make a lot of this stuff happen as seamlessly as we would like. We have a lot of people in name only as volunteers. We need a lot of people that raise their hand and say, how can I help? And so some great opportunities to get help are coming up. Number one, we are about to completely relaunch all of our web presence. I said this in the beginning. We are about to have a beautiful brand new website, both for Real Progressives and Real Progress in Action. So there'll be two gorgeous, brand new, very, very useful resources that we'll be able to start deploying. I was debating about whether I was going to say this part on here or not, but I am. We are in the process of rebranding some of our media content, in particular on e-publication. So right now, largely a lot of the articles that are written for Real Progressives tend to be of the op-ed variety. We are looking to start trying to also get some real legitimate hard-hitting articles where people have done the investigative work, have reached out and interviewed people, doing Jacobin level type work. And we're going to name this publication the Dreadnought, And I want to explain to you all why we're going with the name Dreadnought. So Dreadnought was a ship back in the World War I era, turn of the century, 1900s. The English built the HMS Dreadnoughts back then as a counter to the French, who had started putting steel on their ships. But the idea here is that everything that Real Progressives does, and all of our signage and all of our taglines, you name it, has always been Real Progressives is true north for the progressive movement. And the idea of using nautical symbols and understanding that we're an agent of change. And nothing was more transformative in that era, which happened to lead into, nonetheless, the progressive era. We are using this transformative beast because prior to the Dreadnought, it was these big galleons, these big, huge ships with sails and cannons, and all of a sudden the Dreadnought came in, and that was when the destroyers and the battleships took place. Well, obviously, our weapons are not for war. Our weapons are for our mind. So the tagline for this will be Dreadnought weaponizing knowledge one mind at a time. And so as we have our each one teach one strategy, the written word will be using the old battleship. That'll be kind of the Dreadnought look and feel will take on somewhat of a nautical flavor. And we're going to do a lot of work to make sure everybody understands that we're not pushing war. The idea is pushing knowledge. But this term Dreadnought also plays into some futuristic looks as well. And that's going to be for our media. And so if any of you all have ever done Warhammer 40,000 or anything like that, there's a modern version of the Dreadnought, which is the most brilliant of the warriors that perished, and they put them into these cybernetic beings, and they were able to basically wreak havoc on the smartest guys built into these machines. So we're kind of bridging divides. We're a disruptive force. That's the kind of ethos that we're trying to put forward here. That's the vision statement. It's kind of the purpose. So I'm very excited about this. The look and feel, the logos, everything are going to be the type of stuff you'd be very proud to put on a hat, a shirt, whatever. So hopefully it'll help us for people that maybe have a bias against the word progressive. It'll allow us to brand out a little bit more and get some of this knowledge in people's hands that maybe don't even bother looking because it says progressive. The next part of that is that we have taken on a new platform, and that platform is called Rockfin. And Rockfin is a pay-for service. So there is a component of subscribership. However, we are putting out free content, and we will eventually put some premium content out there so that we're keeping pace with the Jimmy Dores and the other folks that are on there with us, Kim Iverson and others. If you haven't signed up and subscribed to us yet on Rockfin, please do. It's free to at least see what we're doing. However, there is a $9.99 monthly fee if you're interested to get the full bundle of all the content within that media segment. It's a neat platform. It's unique in the sense that they do a lot of marketing for you. They help get the word out. So it'd be great if we could have some great support on Rockfin. The next big thing is we are moving from Libsyn, which has been our podcast platform for the last year plus, and we're moving to a brand new upstart platform that has got a lot of bells and whistles and is really got the leading voices that are pushing it, and it's called Captivate FM. And so we're very excited about moving into Captivate. You're going to see some changes in terms of the player. You're going to see some changes in terms of us being able to put calls to action in our podcasts. We're hoping that we'll also, because we're going to be housing this on our own website, we're going to be trying to get transcripts up and running as well. The transcripts are expensive. Let me just be honest. To get the computerized version that's completely jarbled is like $7 per episode. To do it with a human person, it's like $70 an episode. So we have to kind of balance that out. And hopefully we have some people on the team that raise their hand and say, I'd love to do transcripts. So we have lots of work for you to do if you're interested.
I think the last piece, I mean, there's more than this, but I'm just going to stop it here, is that, clearly as part of our education pillar, and you see events like what we're doing right now, these would be far better served if we were doing them on a platform that was meant for this sort of thing. And Zoom sucks. I don't like Zoom at all. So the idea here is that we're going to be moving, after evaluating about 5 or 6 of the leading webinar platforms. We ended up starting with a very, very robust cutting edge platform called Livestorm. But we realized that the usability factor for some of the people on our team might be a little bit more tricky than it was worth. So because there's a large community, a network community out there on Crowdcast, we are going to be getting a very, very high-end version of Crowdcast so that we can link up future things that we plan on doing with chapters and other such things. And it will allow us to do virtual seminars, virtual conferences. It'll allow us to do these national outreach calls. It'll allow us to do book reviews. It'll allow us to do debates. It'll allow us to do so many things that we haven't really done well. We've tried to do in different formats, but we haven't really done it well. So this is an exciting curve. And I should say one more thing. I'm going to add one final thing. As many of you all have seen, I have not been able to go live as much lately. And part of that is a COVID-19 situation. I have been playing stay-at-home dad with the, working from home full-time and taking care of both kids throughout the entire day. So a lot of the time I had in the past, because I got to go into the office, is gone. I don't have those free spots to do a lot of the things I once did. So by the time I'm able to go live at night, it's just quite a challenge. So in order to get Steve back on the camera and be able to do interviews and stuff like that, a new guy named Cole Ford has stepped up, and he really worked hard to figure out how to use our state-of-the-art live streaming platform called Studio 6, and he's learned it pretty well. He got me a Mevo camera, which is going to allow remote control over the studio, so I won't have to be playing, engineer and host and questioner and all the other things I do when I can go live by myself. And so this is very, very exciting. It will allow us to have a real bona fide professional looking studio and allow us to go from what looks like a semi-unprofessional environment to a very professional environment. And it should allow us to do a lot more interviews. And quite honestly, once we open up the studio, we'll be able to bring in protest footage, let's say, from all over the country. We can have multiple streams going at once, baked through this. So look for a lot of really exciting stuff. Hopefully we get, everyone leaning in and saying, how can I help? And we'll have people waiting in the wings to show you exactly what we can get you going on. So with that, hopefully that gets you guys excited. I know things are a little tense right now, scary with the election, scary with life. But hopefully we can provide a way for you to feel like you have a means of fighting back, and we can provide you that avenue if you just lean in and give us a hand. And we really appreciate it in advance. And Bob, thank you so much, sir.
Steve, I just want to remind people, if they do want to subscribe to Rockfin, it's $10 or $9.99 a month for all the content. You don't have to subscribe to us and then Jimmy Dore and then whomever and whomever. You just do it once. But please do it from the Real Progressives channel so that we get credited for it.
Thanks, guys. Thanks so much. And looking forward to the next one. Keep it up.
You got it. Thanks, Bob. Thank you so much.
Okay.
Thank you.